Brian, welcome back. It's nice to see you today from Toronto. Last time you were on with us, a couple weeks back, you were looking for a December rally. I think you were anticipating a good CPI, which we got, and it sure looked like you were going to be right. Today feels like a different story, though. What's happened?
It really does, and thank you so much for having us. It's been a great year with you guys all year long, and happy holidays, Merry Christmas. You know, we thought that the market would be reacting more to the change in trend in inflation. It was, and then all of a sudden, you know, I think the Fed speak created some nerves, as it should. You know, the Fed is something that you can't fight. Mr. Weiss has had a wonderful year with that call. So have the bears, and so have the macros. And so we said coming into 2023 in our year ahead piece that the first part of the year would be weak and choppy. We seem to be pulling that a little bit forward. And so the pullback's already begun in our view. And I think it's going to be tough for the Santa Claus rally to occur, number one. Number two, everybody and their mother, brother, sister, cousin, uncle is negative on the first half of the year. So we'll come out and be a little bit different. I think the weakness probably is not going to be as long as everybody thinks. It's probably going to be into February as earnings start to come out, and into March. And then we'll have some sort of a bottom, let's say 3,600 to 3,800, something like that. And that's when we'll have an opportunity to put a little bit more risk on in our portfolios, which when we run our money, we're very, very tight right now to the market in terms of our overweights and underweights. And so we have an opportunity to kind of move some money around, we think, the first part of the year.
Mm-hmm. Let me just ask you a simple question, because I feel like you're in this camp. Why do you keep fighting the Fed, Brian?
Well, I'm not fighting the Fed because, you know, I think, as I said in my explanation right now, and from our report next year, we think that prices will go lower the first part of the year, especially given the fact that the Fed is signaling what it is. And with this massive inversion of the yield curve, it's not different this time. We are going to get a recession. We know that. Whether or not it's happened already, again, it's a moot point. Our base case still is for some sort of a mild recession in 4,300 next year. By year end, I think the second half of the year, I think starting earlier, maybe March, April, could be very, very strong. I think the key is going to be earnings. I don't think earnings are going to go down as much as everybody thinks. That's where I do actually think we could have a deviation relative to history. We're not going to have a 20% drawdown in earnings. I think something more to the tune of 220, maybe 215, something like that from our current 230 level. I think that's enough.
But do you think you're fully appreciating what Jay Powell seems to be continuously signaling, right? I mean, he's been hawkish, he's been consistent, and he's not the only one who is telling you, and I mean the collective you, all of us, what they're going to still do. Do you think that they're not going to be able to do what they suggest, and that's why you only think we'll have a mild recession and that earnings won't be hit nearly as bad as some think? Your earnings number for 23 is $220. That's fairly elevated, I think you would say, compared to what some other projections would suggest.
Correct. So if you say that earnings kind of peaked out at 240, that's a 20% pullback to 200 where everybody else is. I think that's just lazy math. I think people are being too easy on that, number one. Number two, again, I think too many people, too many strategists look from the market level, don't own stocks, don't look at sectors and industries. When you roll all that up, we can't see where the earnings weakness is going to come from. We just simply cannot, especially given where we're seeing in energy and industrials and even parts of technology, healthcare, financials. We think the earnings are going to hold in there a lot better. Plus, if you take a look at how companies operate their businesses in terms of operating performance and cash flow, it's the strongest I've seen in 30 years. And so I don't see this massive recession, of earnings in general. But I do think we're going to see some earnings softness that could cause the market to go down a little bit the first part of the year. But I do think the Fed is following its script. We know the Fed is going to go too far. Now, everyone knows that. The bond market told you that yesterday. The bond market's obviously stronger because the bond market's seeing the recession right now. And so once again, bonds are right. The Fed is going to go too long, and I think that's what you have to position for right now.